You know, every set of quarterly results tells a story. So today, we're going to unpack the latest one from GE HealthCare. We'll dive into their performance, uncover some of the hidden challenges, and explore their game plan for what's coming next.
All right, so we're jumping right into the official data, straight from GE HealthCare's fourth quarter earnings report that dropped on February 4th, 2026. Let's see what the numbers are telling us.
And the headline, right out of the gate, it's a good one. GE HealthCare delivered a really strong fourth quarter, performing better than Wall Street analysts had predicted. So what does that actually look like in numbers?
Okay, first up, revenue. They brought in $5.7 billion. And to put that in perspective for you, it was nearly $96 million more than the market was expecting. A very, very solid top-line performance.
It's pretty much the same story with their earnings per share, or EPS. The company posted $1.44, again, beating what everyone was forecasting. So the crucial thing here is, they weren't just making more money, they were also more profitable than anyone anticipated.
And this one is a big deal. Free cash flow came in at a robust $916 million. Now this is a critical indicator of a company's financial health, right? It shows their ability to invest, to pay down debt, and return money to shareholders.
So what we're seeing is a strong beat on all the key metrics. Let's get a clearer picture of this report card and see just how much they really outperformed. Now, what's really interesting here is seeing the direct comparison. You can see revenue beat by about $100 million, and EPS came in 4 cents ahead. It's this kind of clean sweep across the board that really gets investors' attention.
And the good news wasn't just about the past quarter. The company ended the year with a record-breaking order backlog of $21.8 billion. Just think of this as a giant pipeline of confirmed future sales, which gives them fantastic visibility and a lot of confidence for the road ahead.
But here's where the story gets a little more complex. Because even with these fantastic results, the company was battling some serious external pressures. There was a pretty significant challenge hiding just beneath the surface of those headline numbers.
The performance was strong, absolutely, but it definitely came at a price. The company had to overcome a major financial headwind that was actively squeezing its profitability. So what exactly was this hidden cost? And here it is, a $245 million negative impact for the full year, coming directly from tariffs. I mean, essentially, these are like unexpected fees on key components that directly ate into the company's profits, making everything they do more expensive. And this slide illustrates the real story perfectly. With the tariffs, their earnings per share grew by a modest 2.2%. But, and this is the key, if you strip that headwind out, the company's underlying growth was a powerful 12%. This just shows how much those external costs were masking the true strength of the business.
So, how is GE HealthCare fighting back? Well, let's move on to their strategy. Their first line of defense is actually a powerful offense, a major push in innovation and new technology. And the results are pretty clear. A stunning 55% of the company's revenue now comes from products introduced in just the last 3 years. This metric, it's called the vitality rate, and it proves their investment in R&D isn't just for show. It is directly translating into sales. And that vitality rate is being fueled by a pipeline that is just packed with cutting-edge technology. We're talking about everything from next-generation CT scanners and advanced MRI systems to brand-new molecules for cardiac imaging. This really is the engine of their future growth. To understand the scale of their ambition, just look at this quote from the CEO. He's not just optimistic about one of their new products, Flyrcado. He sees it as a potential billion-dollar innovation. This highlights the massive potential that's locked within their product pipeline.
But innovation is only one half of their strategy. The other half is all about execution and efficiency. To achieve that, GE HealthCare has implemented a proprietary internal system designed to make every part of the business run better.
They call it Heartbeat. It's basically their internal playbook for operational excellence. The idea is to create a steady, disciplined pulse that runs through the entire organization, focusing everyone on continuous improvement across all those key areas, like quality, delivery, and cost.
But is it just corporate jargon? Nope. Here's a perfect real-world example. They use the Heartbeat system to tackle a backlog of past due orders. By applying its structured problem-solving approach, they improved communication and alignment, and ultimately, that led to a 25% monthly improvement. That is a tangible, measurable result.
So, with a strong quarter behind them and a clear strategy in place, what does the future hold? Let's turn to the company's official guidance to see what investors should expect in 2026.
So here's the outlook. They're projecting continued organic revenue growth, expanding profit margins, and strong earnings per share growth. It's a confident forecast, and it's important to note that this already factors in a pretty cautious view on their business in China.
So the takeaway here is clear. GE HealthCare delivered a powerful quarter, even with significant headwinds trying to slow them down. They're pushing back with a two-part strategy of relentless innovation and sharp operational discipline, all while forecasting more growth in the year ahead.
This brings us to the final crucial question. GE HealthCare has a clear plan and strong momentum. But in a world full of economic uncertainty and geopolitical challenges, the big question remains, will their strategy of innovation and efficiency be enough to win the race against those powerful global pressures? I guess that's the story to watch.